Welcome to the REI Diamond Interview, your source for real estate investment jewels of wisdom with Dan Breslin.
Welcome to the REI Diamond Show with Fettke. I am Dan Breslin, host of the REI Diamond Show. On this episode, I've invited Kathy to share her experience on market cycles, private lending, and land development. Kathy is the founder and host of the Real Wealth Show, which is a podcast I suggest you check out at realwealthnetwork.com. In this episode, we are going to cover the three must-haves of selecting a winning real estate market to invest, the number one thing to bring to the table when asking a much more experienced and successful investor or real estate developer to be your mentor. And here's a hint, it's not a check. And for married investors just getting started in the business, a couple suggestions on the best course of action for succeeding in the business early on while maintaining your marriage. Without further ado, welcome to the show, Kathy.
Thank you so much for having me.
So I'd like to get started just so people can get a little bit of a background. Maybe what led up to you getting into real estate investing and, a Reader's Digest version of what your business model and business looks like today over the past, 12 to 18 months.
Sure. Well, what got me started was all kind of by accident and luck, really. My father had an apartment building in California, but it was not cared for, and he was in a syndication, which means that it was managed by someone else, and he just owned shares. Well, they didn't manage it well. He didn't pay attention. He was a dentist, and the property went into disarray and was sold at a loss. But he had been depreciating it all those years, which meant that he would have to pay enormous capital gains, hundreds of thousands of dollars, and he didn't have that money. He was in retirement. So all he could do was exchange the property and hope to defer the taxes, but he had 2 weeks left by the time he found out that the property had been sold. I jumped in. I'd just been married, and I thought, Dad, what's the big deal? All you need to do is find a property. Let me help you with that. And I found one that day. I was a renter at the time. I found this house that I would like to say I was led to it divinely because it was perfect, and it was my dream house, and it was huge and way more than I could afford. However, I could see at the time, without being a real estate investor, this was 97, that there was opportunity that if ever we ran into difficult times, it was such a big house we could rent out rooms. My dad agreed, and we bought that house, and we became his tenant basically with the intention of owning it at some point when, we would inherit the home. And so that took the financial burden off him. Sure enough, we did run into hard times. My husband had melanoma, a pretty severe cancer, and the medical bills really wiped us out. But we were able to rent out. It was like a 6-bedroom house, and we just rented out a bunch of bedrooms and pretty much lived there for free. I learned a lot of lessons in that. One, that the passive income from real estate could really take you and carry you through difficult times and not difficult times. I mean, it could just help you create the passive income you want to retire and deal with these kind of unexpected expenses. And I also learned that when my father passed away, the property stepped up to market value, current market value, and all of that property, all that capital gain was just wiped out, and we inherited the home. And so it was just a total win-win for everybody. I got hooked. And then from there I started, like you, I had a radio show already called The Real Wealth Show, and then it ended up being a podcast and is number 2 on real estate investing on iTunes right now. What I've done since then is basically interview people who have success stories kind of like mine and just find out what people are doing and learn. And my audience learned and loved learning things that they had never heard before. And so our network grew and grew to where we have now 20,000 members at Real Wealth Network and still growing.
That brings up an interesting point. So that's probably one of the most rewarding pieces for me. I did not have broadcasting experience or a radio show before. I was in the business for like nine years, and then I started the podcast. But it has definitely opened up my eyes tremendously by having guests like yourself come on the show and just share the different strategies. I mean, it sounds like that was a big part of your quote unquote mentorship in the business. Would I be correct in assuming that, Kathy?
Oh my goodness. Yeah, absolutely. I mean, when we ran into hard times and, basically our savings was wiped out from the medical bills, that's when I really dove in and brought in experts of all kinds to teach me. I mean, it was really for selfish reasons, honestly. The radio show gave me a platform, right? People won't just talk to you, but if you got a radio show, they might. So
you're right about that.
So I would ask the questions I wanted to understand and learn, and I did. And in so doing, I helped a lot of our listeners also gain this financial intelligence that is really not out there. You don't learn it in school. And yet when you interview wealthy people and successful people, they're really, really happy to share their secrets to success. And I'm sure you found that to be the case as well.
Absolutely. I mean, if we're being completely transparent, that's probably the number one thing. Like, I don't do coaching. I don't do, run to the back of the room. I don't sell things. Probably the number one reason that I do the podcast is for that opportunity to have that platform and get successful people to close the door for an hour, hour and a half, no distractions, and ask the questions that I want. And the best part is it's, recorded and then it's distributed to the audience, which is like a icing on the cake,
Exactly.
So Kathy, tell us a little bit about what the business model looks like. Where are you and your company winning and your investors winning in today's market? I mean, we're talking like, 12, 18 months back, and what is the mechanics of your business look like today?
Well, it's the same concept, which is, I've only been an active real estate investor for 13 years. So I've only been through one sort of down market that went up and then went down and now it's back up. So I guess you could say it's two cycles, but I've tried to get my advice and interviewed people who've been through many more cycles and have a lot more experience than me. That's kind of how we've done our investing as well. So over the last 12 to 16, I guess you could say the last 2 years, I mean, you could really say since I began, we have partnered with people with far more experience to help us so we don't have to make the mistakes that they made. And of course, they can benefit as well. So an example is a few years ago, land was pretty cheap. I mean, mostly in 2010 and 2011, some in 2012. People just weren't buying it. It was not time yet. Developers were wiped out and they couldn't get the financing. So there was this opportunity to buy land for super cheap if you could come up with the money. And, a lot of what I've done has been kind of by accident, not just trying to do a good thing and offer great content, which ended up building a huge audience. And so, I thought, hey, guys, listeners, I've just come across a developer with 40 years experience with a track record that's unbelievable, but he has no money. He can't go to the banks like he used to, walk in and walk out with billions of dollars, So is anybody interested in buying this property in Portland that went into foreclosure? This was my first group deal in 2010. It was $12 million. We can buy it for $3 million. I would need, a group of investors each put out 50 to 100,000 in, and we can do this. And I raised the money in one email. So I had no idea that was something that I could do. And this was in 2010 when there weren't really a lot of options, for making that kind of money quickly. If you're busy already, you should go buy and flip property, but it was tough. So because we partnered with a high-level developer with experience and lots of great hair, those investors made over 20% annualized in probably the worst part of the recession because we bought the property so cheap. It was a subdivision that actually went into foreclosure and was almost finished. All we had to do was buy it, finish it, and sell it, and we did. And then from there, he was, his track record was built with us, so he found more deals like that. I mean, land we were getting for 10 cents on the dollar. Same thing, we just needed a little bit of, just new re-entitlement, and we were able to flip that to builders for huge profits. Again, things I wouldn't know how to do, but he had done for decades.
That's interesting. So did he come through your audience, or was this somebody you had met, in a real estate meeting? How did you come across this developer, Kathy? That's
a great question. One of our members who was a broker said that you need to meet this guy. So I went to his huge mega mansion in Carmel and, got to meet him and hear his story and view his developments all around the San Francisco Bay Area and I ran it all by my attorney. Again, I have a syndication attorney and land development attorney with 40 years experience. I wouldn't want a new attorney either. He looked over everything and approved, did the background checks. And so we went for it again with the audience. I mean, another thing this developer brought to us was an old commercial building that all we had to do was lease option. So we only had to come up with $1.2 million. Again, I raised that in one presentation. Before the presentation was over, people had been sneaking in the back of the room writing checks. So by the time the presentation was over and everybody wanted to sign up, it was already sold out and people were mad. But it ended up being just like a 40% annualized return because we only had to put up an option fee, re-entitle the land from commercial to residential, tear down the building, finish the lots, and sell it to builders. And they paid $20 million for it.
So all right, let's dig into that one just a little bit. So I just want to talk about something first. So you put this audience together. How long were you doing this radio show before 2010 when you first decided to risk your reputation and put it all on the line and send out an email vouching for this new branch of your business? How long was that for you?
That's scary. Well, I started in 2000 with it's just a little show. I don't think anyone was listening. I was in the news business back then, and I was just tired of reporting negative news, and I thought maybe I can talk to the station, see if they'll let me do a little radio show that's more positive. And so, it had nothing to do with real estate back then in 2000. It was just, I don't even remember what I called it, but it was really just empowering people to live their dreams and go after their goals and that type of thing, Tony Robbins and Oprah style. And, but then when my husband was diagnosed with melanoma and actually told he had 6 months to live, now the doctor was wrong and he's fine and healthy today, but I didn't know at the time, that was 2003, I immediately changed the topic to how do I make money and how do I make it fast and passive income, because I had 2 small children and I wanted to stay home with them, even with this chance that my husband, who had been also the money guy, the possibility that he could die, even though I really never believed it, but I had to prepare. And so it was there that I just started interviewing people that had come from nothing and made money. And I just made it my mission to understand it and learn it. And it all it's amazing how just shifting the mindset and learning what others have done that you want to do can just change everything.
That's an amazing story. I mean, talk about the silver lining from the cloud. I couldn't even imagine having to go through, an experience like that, losing or potentially losing a loved one, and to take immobilized action like you did. It seems to be, it's just mind blowing. I mean, like you said in the beginning of the show, it's like the divine leading you along the way. And I would only venture that would be the same thing right there.
Yeah, I have a strong faith, not really based on any particular religion, but just, I was born and raised Christian, and I just have a very strong faith that I'm protected and loved. And maybe it was denial. I don't know. I just didn't believe it. But at the same time, I was driven by love that, he's been on the treadmill. He needs to get better. If the doctor's right, which I'm sure he's not, Rich better enjoy the last 6 months of his life. I better figure out how to make money. And I had been always someone who followed my heart, so I never really took jobs for money. I was in the news business making very little money. The only way you make it big there is if you go national anchor person, but otherwise you're doing it for love. And so all of a sudden I had to shift everything and say, well, my time needs to be spent making money. That's it. But I couldn't just sell my soul. It had to be something I also loved. And it turns out what I discovered was learning how to make money was actually pretty fun. if you do it, because it's a win-win if you do it right. It's the same thing. We're cleaning when the foreclosure crisis hit. We as investors went in and bought these dilapidated properties, fixed them up, and improved neighborhoods, and provided housing for people with rental properties. And that all that again is a win-win. The investors can make a return, and renters can have a nice place to live, and good landlords, and neighborhoods get cleaned up from these what they call zombie foreclosures.
Yeah, you're absolutely right about that. So we touched on the land a little bit, and you mentioned the foreclosure crisis. I think you told me that the single family is where you guys focus the majority of your business. Could you talk about that a little bit, Kathy?
Well, I think what we learned from aligning ourselves with people who have done what we want to do is that markets cycle. And you need to know what cycle you're in because that's what you buy. So it's not even so much that I love single family rentals. It's just that that's what the opportunity has been. And then I didn't know anything about land development, but shoot, no one was buying it and it was cheap. It was the thing to buy. And so today, what's that thing? That's what you have to be constantly looking at because it's constantly changing and it changes faster than ever because of so much government manipulation. So cycles cycle bigger and faster than ever before. And if you're doing what worked a year ago, you're going to get hammered next year because it's going to be something different. so sure that, in 2009, 10, it was single family homes. They were cheap. Before that, we were actually aligning ourselves with builders and trying to take, 10% of their inventory. And that's kind of where we're at again today. We've cycled from too much distressed inventory to almost none. The amount of foreclosures is half of what it would normally be in a normal market. So we've gone from massive foreclosures to almost none. And we've gone from way too much inventory to almost none. I mean, that's what you hear every month. There's just not enough inventory because the builders stopped building. They got wiped out. And so there's an opportunity today and still picking up some of these foreclosures, which you can only find in certain states, the judicial states. So that's still an opportunity. And the other opportunity is building because there's not enough inventory. And then rental.
Okay.
Rental housing is another huge opportunity because lending laws are so strict and prices have gone up and people can't afford to buy a property, so they're forced to rent. So, being a landlord, huge opportunity today. Providing more inventory, huge opportunity. And then still buying some of the foreclosures in judicial states is another great opportunity.
So 2010, 2009, obviously you look down the horizon and you say, oh my gosh, these single family houses are so cheap, we need to buy them. Now we're 6 years later, and from what I can tell, you're saying the big opportunity is in single family new construction. Is that kind of where the opportunity lies now, Kathy?
Yeah, if you want a quick in and out, that's it. Some states are really good for flipping properties, but you got to be real careful because the music could stop at any time. If interest rates go up in the high-priced markets, you'll see a slowdown. We're already starting to see it. So flipping, wow, you got to be really careful. But renting property, the rental demand is going to be stronger than supply for the next probably 10 years. So, huge opportunity in rental property. And then building, if you just don't want to be a landlord, aligning with builders, that's kind of an in and out situation where you don't have to, again, be a landlord. Another opportunity, if you don't want to be a landlord, is being a lender, because lending laws are so strict that not everybody can get a loan, but people want to own. And in many cases, it's cheaper to own. They just can't qualify for the loan. So private lending is great. You can get 6 to 8, even 10% return without being a landlord.
And when you say the private lending without being a landlord, just dive into that, a couple different ways for listeners who might not be clear on what exactly you were talking about.
Sure. Let's say you have an IRA. You got money in the stock market, but you don't feel comfortable there. It's too up and down, too volatile. So, but you want a steady return. You can self-direct your IRA and do something else. And one of the things you can do is lend like a bank. So one of the programs we have at Real Wealth Network is private money lending. And the way we design that, there's lots of different ways to do it, but the way we do it is we lend to teams that we've approved and vetted who are buying foreclosures and fixing them up and then reselling them to people who want rental property, who want to buy already done for you rental properties. Because a lot of people out there don't have the time to go buy and fix properties and then rent them out and do all that. So we have about 12 teams that we've identified across the country that are experts at doing that, and we just lend money to them. So we've pooled investor funds to do that. And investors are getting, basically the borrowers who are these teams, they'll pay 10% to borrow that money. Now, there's all kinds of ways to do it. Let's say, a family member wants to buy a property, but they can't qualify for a loan. You can lend them the money, from your IRA or from, whatever money you have. And just like a bank, you would secure that to the property in a first lien position. with enough equity cushion that if prices went down, your money's still protected. It's probably one of the safest ways to invest and get a steady return without, really having to do much except lend the money, as long as, you know what you're doing and there's plenty of equity there. And that your lien has been recorded and that you have paperwork that makes it really clear, explaining that if the borrower stops paying you, you can foreclose and take the property back, which in some cases ends up being even more profitable if they stop paying. The only thing is you don't want to do lending. Never, ever, ever be a lender in judicial states, because in those states you actually can't foreclose. It's very, very difficult, which is why, that's why it's an opportunity for us, because places like Florida, New York, New Jersey, Pennsylvania, you never want to be a private lender there, because if your borrower stops paying, you have to go through a court process to foreclose, whereas in trust deed states like California, you just foreclose the first time they miss a payment. It's pretty quick.
You pretty much go in with like a shotgun and basically push them out the back door. That's like how easy it is in California, Kathy.
Any of the Western states, any of the trust deed states, which is shocking because California tends to be more liberal. You'd think they'd have judicial state policies, but it's pretty quick and easy to foreclose, which is one of the reasons why the West has recovered so quickly, because somebody doesn't make their payment, the lender can foreclose, put that property back on the market and get it sold. And the judicial states, these properties, it can take 3 to 6 years to foreclose. Yeah. And then those properties get dilapidated and then the neighborhoods go down in value. It's just, the idea was to help the homeowner, but it's really hurt them.
That's ironic, and you're kind of killing me, because some of the listeners come on the show are my lenders, Kathy, and I am in Illinois, Pennsylvania, and Florida, which are all 3 judicial states. So,
well,
my little disclaimer, we typically do a deed in lieu of foreclosure. We kind of do some other things to protect our land, but we're also doing investor loans. My dad's money went into one of my members of my network from his self-directed IRA. No deed in lieu or anything like that, but like you said, it was kind of a vetted, trusted team on the ground, or I wouldn't have directed my dad to invest there. And we did 9% for a year. It's a 12-month term. And are these 10% terms, are they generally short term, or are they literally, 10, 25, 30-year terms on the loans that you guys are doing to the 12 teams across the country?
They're short term. Yeah, these guys flip them in 3 to 6 months. But hey, listen, I don't mean to say, obviously lenders are lending in the judicial states, and so there's got to be a profit, and you've got to know what you're doing. I'm just saying you've got to be more careful and have an expert like you to guide you through that, because if you do it wrong, you can really be sitting trying to figure out what to do if you're not. Yeah.
You're absolutely right. And I always tend to be careful. I run 2 real estate investor associations, one in Chicago, one in Philadelphia. And I'm very careful when I'm in front of the room and talking about private lending, because even to say I generally shy away from saying oh yeah, you want to own the property if you get it back and it could be more profitable. I try not to say that to people, because if somebody has not a lot of experience, they might consider a deal at 85% of retail value in, let's just say, a $200,000. They may think wow, that's a great deal. Houses go on the market for $199 and I'm lending $160,000 on it. This is it's super safe bet, and they don't understand the closing costs and things of that nature. So I generally, like you just said, I generally suggest that they get with somebody who's an expert in that market, watch that person, figure out if this person is capable of, bringing back the returns. And if all things check out, you definitely got to have a little bit of a trusted advisor for the private lending as an opportunity.
Yeah. I don't mean to make it sound as easy as I might have, but it is. When done right, private lending is the easiest way to make a steady cash flow without having to deal with repairs and probably everything you teach. But I've seen people do it wrong. I'm sure you have too.
It's a shame too, because a lot of times it's people in their, retirement years, and they necessarily weren't ready for a court battle in the judicial state. And, to take a $60,000, $70,000, $100,000 loss out of the, the retirement account, that could be, for some people, that's 80% of their IRA account. For some people, it's 30%. It's just, to your point. But let's not dwell on that. I wanted to go back a second. You said something that was interesting, and you and I were both on panels at the IMN Single Family Rental Conference in Miami. That's where we met, where I asked you to come on the show. And you mentioned some things about markets and I wasn't taking notes, which I characteristically usually take notes everywhere I go, like I am now. But you talked about the emerging markets, and you mentioned the government manipulation of markets. Could you talk about the government manipulation, and then we'll kind of like switch into why you believe certain markets are better than others in the United States, Kathy?
In real estate or in stock?
Well, that's intriguing. I assumed it was real estate with government manipulation, but I'm interested to hear how you would answer the question. Freedom is yours.
Well, you know, we know that we already know the government manipulation that caused the last crisis, which was allowing, well, you know, we don't even have to go into that. We know what happened. And the way that the government tried to fix that problem was more of the same. So we had a major debt crisis that collapsed, and the way that the U.S. government fixed it was with more debt. And so that's kind of where we are today, where interest rates have been at near zero levels for almost a decade. Of course, interest rates went up slightly in December, and there's talk of it happening again in June. But the damage has been done. So with extremely low interest rates, which basically meant that companies could borrow, let's talk about the stock market. So companies could borrow money for almost nothing and invest in their own stock. So one of the reasons that the stock market is so high right now, when you really look at it, it's not investors. It's the majority is banks, is companies who have borrowed money to buy their own stock and inflated their stock value. So it's pretty scary. Because eventually, you know, they don't have to pay interest really on it, but they're going to have to pay the debt back. it's
At
kind of
some
like
point,
saying,
right?
yeah, it's kind of like saying, you know, I own this property, but nobody wants to buy it. And so why don't I buy the property next door? I'll borrow 100%, buy the property next door, but I'll way overpay for it. And that will bring up my comp so I can sell my house, but now I own this other property. So it's just manipulation. It's not cool. So people need to really look into that, the corporate buybacks of their own stock that's really been driving this stock market bull run. And so how has it affected real estate? Well, similarly, we don't have the same problem we had with the last downturn, thankfully, where loans are really good and solid right now. We have, like I said, the lowest foreclosure rate, half of what would be a normal market. It's like 0.5%. So loans are good, and foreclosure is not a problem right now. But what could be a problem is all the, just the extremely low interest rates that basically inflates values because, mortgage payments are lower. Now, will rates go up? One of the reasons that rates have been down is similarly what I said before, government manipulation, where the government's buying its own bonds. So mortgage rates are tied to the bond market, and when bonds sell, that usually generally means that the economy isn't really booming, and therefore interest rates stay low. But the government's been buying its own bonds, so there really hasn't been a market for it. That's just kept mortgage rates low. Now, it will change, and at some point, you can't keep doing that. So eventually, interest rates will go up, and we're going to see certain certain markets where real estate values will decline as a result. And that's really going to be the markets where affordability just isn't there.
So your perspective, you're thinking, the San Franciscos and the $1 million plus name, Phoenix, Arizona. Would I be correct in those assumptions, Kathy? Would be the hardest hit by 0.5 point interest hike?
Yeah, it's any area where the average income just is not in line with the average home price. And so take the whole interest rate factor out of the deal, and an easy way to calculate, in my opinion, this is pretty easy. You can look at the average income, let's say it's $50,000. Then the average home price should really not be more than $150,000 and certainly not more than $200,000, because the average person really couldn't qualify or pay for a house that's more than 4 times income. And same with payment. right? Because you can't have your whole paycheck go to your housing expense, although in California we managed to do that. But, so it could be anywhere. I mean, you look at Portland and Denver and Seattle and, like you said, Phoenix and some of these areas, Miami, New York. Miami and New York are a little different because there's so much foreign money coming in there. But these other areas where, if prices stop going up, I mean, that's part of the deal is people see home prices go up and they want to jump in and enjoy that ride. But when they start to see them soften or decline, it's a whole different story. And what would cause them to soften or decline would be an inability for people to buy. So if interest rates did go up and suddenly that knocked out a bunch of potential buyers, then you start to see a slowdown and possibly a reversal, and then everybody freaks out, and then headline news comes in, oh no, we're having another recession, then more people pull out and try to sell, and there's more inventory, and then we do what we do every 10 years, which is have a recession.
We have a couple interesting dynamics going on right now that you mentioned, and one was, I mean, just from my own perspective, there's a population supply of people, in the age of, say, 21 to 34 who are going to come online and start buying houses. And to your point, they're not necessarily going to be able to pay more for the property if the interest rates go up slightly. Does that price those people out of certain markets and then cause like a secondary increase in markets that are perhaps, 45 minutes away or, an hour away from the major, the MSA that they are located? Does it cause like a secondary ripple? I mean, they have to live somewhere. Do they stay in rental property? Are they forced to stay in rental property, or do the prices, allow for builders of property in $150,000 to $200,000 range? If somebody can master the low cost build in certain areas, are they going to win as opposed to like a full out? My only real memory is 2007, 8, and 9. And, so when you say like recession, I'm like, oh my gosh, it's going to be like this chaos, end of the world situation. I don't know that next dip is going to be quite as drastic as the last one.
I don't think so, unless we just have a major stock market crash. But I don't think our current administration wants to see that. They're going to try to put it off certainly after the election, and who knows after that. It really comes down to me, it would be a stock market crash. And that would really affect more affluent areas, because when you're in secondary and tertiary markets, those people aren't really necessarily invested in the stock market. So it wouldn't affect them as much, but the high priced markets would really get hammered. In answer to your question about population, I think you mentioned the young people, the millennials, ages 18 to 34. They are the largest population now in the U.S. They've overcome the baby boomers. The baby boomers really drove the economy for 6 decades because there are so many of them. And just last year, they were overcome by their children. And so now you've got the 2 largest populations in the U.S., both that are roughly around 80 million people, 70 million something. And that's a lot of people. And so we've always had to pay attention to the baby boomer spending habits, because whatever they were spending their money on would boom. So for the past 40 years, they've been investing in the stock market, and the stock market pretty much boomed, besides its ups and downs. But guess what? They're retiring now. This is the other problem with the stock market is, this generation that drove the stock market is now pulling their money out of it because they're retiring. They're not contributing to it. So who's going to take their place? Their kids? I don't think so. I'm a baby boomer, and trust me, my millennial kids are not contributing to the stock market.
Not a chance.
And so
no, not a chance.
we got to pay attention to now what the millennials are spending their money on and what the baby boomers are spending their money on or not, or pulling their money out of. And so the millennials aren't in a huge hurry to buy. They're not going to do what you just said. They're not going to do what their parents did, which was live an hour from their job just to own a home. They don't see the value in that. They're the first generation that saw real estate as a terrible deal. They saw their parents lose their homes, and they saw the world economy collapse because of housing. So they're not going to drive an hour just to own an asset that could do that. Not like the baby boomers who never ever saw a downturn, not a severe one. So it was worth it. So basically these millennials are like, no, I'm going to rent and I'm going to live near my job and I'm going to have a quality of life and I'm not going to make money in real estate. So no, they're going to rent for a while. And then at some point when they have families, which they're doing at a later time in life, they might buy a home and, might see it from a different perspective, but not right now. So because the largest group of millennials is about age 23, 24 right now, it's going to be probably 8 to 10 years before they even think about owning. I mean, that's not all of them, but the majority. So we have a huge renter population. And then oddly enough, I just did a story on baby boomers who are now the fastest growing renter population. So it's bizarre. I know. They're like choosing rent almost for the same reason. It's like they want to live in town and they want to be near amenities and they want to enjoy their life and they don't want to live out an hour out where it's affordable. They'd rather rent close in where stuff happens.
Yeah, it's funny. We buy a lot of property from people you just described. I mean, turned into a hoarder house. Next thing you know, they sell us the house, and I go to get documents signed, like right around or the day after settlement or something. And they have this beautifully well furnished apartment, and everything's nice and it's all cleaned up. It's like a fresh start for a lot of these sellers. I mean, that's like on a real micro level right there.
Mm-hmm.
Kathy, tell me about the 12 markets and why did you pick those 12 markets? What things are you thinking about when you've identified these 12 markets where the teams are in place who you've felt comfortable and confident investing money?
Well, first and foremost, we look for job growth because real estate is dependent on jobs. I mean, at least if you want people to rent property from you who can pay you, they should be employed. Unless they're baby boomers in Florida who are living off retirement, then you'd want to make sure they have a nice, steady retirement. But, for the most part, we want to be in areas where there are jobs and recession-proof jobs. And the economy is changing so quickly that everything is changing based on what we used to think was great. Just 10 years ago, I don't know about you, but just 10 years ago, we used to get really excited if a Walmart was being built because we would want to, right? You'd buy stuff near that. No, it's not that way anymore. The internet's changed that. And so all these big box stores are going out of business. And, they're not out of business yet, but they will be. My daughter works for a startup. This kid from her college started this online build. It's called build.com, and it's taken on Home Depot, and they're a $500 million company now. The student from Chico State. It is not an Ivy League school. It is known as the party school of California. So if a kid from the number one party school in California that pretty much anyone can get into can come up with an online company that can take on Home Depot, the big box world is changing and the world is changing. So, when I talk about being near jobs, it needs to be jobs of the future, not the past. And manufacturing, because generally, factories and, these things don't just pick up and move. So we want to see job growth. We want to see population growth as a result of that. And then you add those two together, there has to be the third component of affordability. So, in San Francisco, we've got job growth and population growth, but no affordability, which means kind of no cash flow. So it's terrible for buy and hold. But you look at an area like Pittsburgh, Pennsylvania, that has got some really crazy job growth and sustainable jobs that aren't going anywhere. I mean, CSX is building a huge new campus there, and that's that's not going to just pick up and move. We've got, and then I don't know if you know this, but Pittsburgh is second to Hollywood in filmmaking, and so there's a bunch of like film studios going in, and and I'm helping investors buy duplexes there for $50,000 that rent for $500 on each side. So you just, you kind of can't lose in that scenario. So that's why we like places like Pittsburgh. We like Chicago because it's the third largest city in the U.S., but you can still buy homes for $150,000 just outside the city. I mean, that's crazy. You can't do that in San Francisco, New York, or L.A. So we like Chicago, even though we don't love their politics there, but we like the numbers. I think you can agree.
No comment.
We love Florida because it's a judicial state as much as I think that's a ridiculous government policy. It's great for investors because we can still buy properties there for cheap. And with 10,000 baby boomers retiring every day. We think a lot of them are going to move to Florida, and yet again, you can buy homes for less than what they, were at the peak, and far less than what they're worth, far less than what it would cost to build. So yeah, we love Florida for that reason. And, all Ohio, same thing. It just hasn't recovered yet, but it's a linear state, and it doesn't, we don't see downturns there. So, but we're starting to see a lack of inventory from lack of building. So now for the first time, prices and rents are going up. So cash flow is incredible. And once we find these areas that just make sense, then the second step is if we can find fantastic teams in those areas that really know how to find deals, really know how to fix them up because they have teams in place, they have their own contractors, and then they have property management in place and that can provide, our investors with basically a turnkey real estate rental, then that's the next component.
So you offer the private money portion first, and in a sense, you're helping be the component of financing for the rehab and for these teams after you've selected the market. And then the second phase of or adding a value that you and your team bring is potentially some of your members are buying turnkey rentals. Do I have that correct?
You got it. That's it.
Nice.
Yeah. So somebody like a, Silicon Valley engineer or startup, these guys are working 60 to 80 hours a week. They're not going to run out and try to invest in property, but they're making money hand over fist and don't know what to do with it. So we help them just make it really easy by helping them, giving them the data on the markets, why we like these markets, and then referring them to teams that, kind of like Yelp that just, have great reviews from our members. And so they can basically own rental properties without having to do all the work to find them and renovate them and manage them. It's all done for them.
Yeah, and one thing that is really great about the turnkey rentals that I've come to appreciate is, for that passive investor, you get 8, 9, 10% returns in private lending, and that's great, but you kind of have to keep finding the next deal for that to go into. And then you also have that fixed where a lot of these turnkey rentals, I know the ones that I've seen, you can get the same 8, 9, 10, even 11% return after management fees, maintenance, et cetera, buying a turnkey rental. But then you also have the potential of, the situation has taken place in Ohio where a lack of inventory begins to cause upward pressure on rents and on values. So the value of your asset also increases along with the return. So you kind of have some potential upside there. Although there is also the risk of your property getting, tenant that doesn't pay and you got to do a turnover. And so there could be some other things, as well that come along with that greater return. But yeah, it's really an interesting piece for the right person.
I think it's nice to have the balance because there is more, there's risk in any investment, but you do have the risk of vacancy and vandalism when you own a property that you have to take care of that a lender wouldn't have to. But at the same time, like you said, you get to enjoy the rent hikes and the increased cash flow every year, and you get to enjoy the appreciation. But even more, I think probably the biggest thing you get is leverage. So you can you could borrow 80% to acquire the asset, still have cash flow left over. And, I've taught my members and listeners that if you have about $250,000, let's say that's what you've got, and that could potentially get you 10 $100,000 properties. So $1 million portfolio, 10 properties, $25,000 down on each. If you target it where you're getting $300 a month cash flow after all expenses, after vacancy and repair, maintenance reserves and all that, if you're still getting $300 a month cash flow, which is our target, and you've got 10 properties that you've leveraged, now your return's closer to 14, even 15, sometimes as high as 20%. But more importantly, $300 a month cash flow on 10 properties is $3,000 a month. Now, can you retire on that? Maybe. But what I would prefer to see people do is take that $3,000 a month and pay down one loan, because that's basically $36,000 a year cash flow that you can pay off that one loan, which is about $80,000. Because remember, these are $100,000 properties, so the loan is not much, $75,000 to $80,000. You can pay off your loan on one property in a little over 2 years. That's the ultimate use of leverage. Now you've got one property paid off. Your cash flow goes up. You pay off the next. Cash flow goes up. You pay off the next. You can have all 10 properties paid off in about 12 years from cash flow when all you did was put in $250,000, 12 years from now, you have $1 million equity, and those properties are probably cash flowing around $6,000 a month, maybe more, because rents have gone up, maybe 7,000, maybe even 8. So now you can retire. That's what makes me excited about rental property, even though there are more risks and even though it's, there's more you have to do than with private lending. Private lending is way easier. It's definitely private lending is way better for people who don't, for grandma, someone like that who just, can't take risks, right? But for somebody who's really trying to retire and wants to retire in 12 to 15 years, that's a plan I teach them.
Yeah, I have a friend who's doing something similar. He's up to 160 properties here in the Chicagoland area, and he's doing the same thing. Doesn't take a penny from the entire portfolio, and I think his target is it's low. It's like 7 years out or something like that. All that stuff will be paid off somewhere in the 7 to 10 year range. I don't remember the details, but it's the same disciplined approach to creating a massive portfolio in the fastest amount of time to retire on. Kathy, you're married still, correct? Even after you got into the business and, started working? I mean, how does that work? Because I know a lot of people that I certainly see come out to our ring meetings, the real estate investor networking groups that we run. And that's a big challenge. I know, it will be the wife who's excited about real estate and the husband's saying it's a bad idea, or vice versa, where the husband's fired up and the wife's like, no, we got to buy stock, I mean, how does that work? And you've reached a certain level of your success. I mean, what are some of the challenges and maybe suggestions you could give to somebody in the same situation, just getting started with the spouse?
Have you got 16 hours? That's how long it's going to take. Just
we're
kidding.
going to Reader's Digest first.
No, I watched my mom and dad, and that was back, that was when maybe women didn't have as much power. Let's just put it that way. So I remember, I grew up in Atherton. That is now the wealthiest suburb in the San Francisco Bay Area. It's the heart of the Silicon Valley. And my dad bought a house there for $100,000. Now that house is probably worth $8 million now. I mean, it's crazy. It's not normal, but let's just say that's what happened. Now, my mom, when I was young, maybe in grade school, I remember her saying, Doc, we should really buy more of these. We should buy more and rent them. And you'd be like, oh, Barbara, that's crazy. Why would you do that? Why, crazy talk. And, of course, had they done it, I would be a spoiled trust fund kid and I wouldn't be who I am today. So maybe we weren't supposed to be wealthy, but that's an example of, a couple not listening to each other. Like if he had just got over his ego and said, I don't know, tell me more, and just looked into it, they could have been fabulously wealthy. And when Rich and I kind of got into this, I was definitely more of the let's jump in and do it. And he was definitely the stopper. But he is a trained coach and what I mean by that is a personal coach. He's a business coach. He's really, really good at what he does. So he's trained to ask questions rather than just have a quick yes and no. So unlike my dad, he would ask, well, why? Instead of making me feel stupid for my ideas, it would be like, tell me more. And what do you see? And give me evidence and proof. And I want to talk to someone who's done it. And, he didn't shut it down, but he needed more info and he got it. And so that's kind of how and also because he asked those questions, I was able to learn more. And I was able to look into the things. I would have jumped into something that maybe wasn't good for us. But because of his questions, we were able to move forward, but move forward carefully. So we learned how to make our very, very different personalities work. So that would be my suggestion is guys, women, whoever's the no person, the risk adverse, they should take some coaching classes. They should learn the value of asking questions. And the person who's the quick start, that wants to jump in and do it, should learn how to listen to those who have questions and get the data needed. So, it can be an incredible win-win situation, whereas in many cases it just turns into a fight, So that would be my best bet. And still both people have to kind of change their personality. Like the risk averse is going to need to look at that documentation and eventually just take a risk when they have enough data. And the person who's the quick start person just needs to learn to slow down a little and get the data needed.
Kathy, Who is the most successful real estate investor or developer and why? It could be somebody that you know personally, publicly, dead or alive. The important aspect of this question is why you think they're successful. And I know sometimes the person that people think are successful may not want to be mentioned by name. So if you want to keep them anonymous, that's fine too.
Sure. It's really that developer that we've aligned ourselves with. He is 72 years old now. He retired when he was 50, and his story is, you can only play so much golf. He's like losing his mind. And then the financial crisis hit, and he couldn't sit in retirement. He just couldn't. There were too many deals. And yet, in the past, he could walk into a bank or into an institutional fund and walk away with however much money he wanted, but that wasn't the case. When we were introduced, it's like, well, yeah, I guess I can raise the money. I didn't know I could, but apparently I can. And he couldn't bring the deals and oversee them, so it ended up being a great partnership. But what I've learned from him, that I think is just something that comes over time, is he does not take risk. He will turn down 99 deals before he lands on the one that he knows is good. And, of course, he knows it's good because he's got the experience. When I have interviewed him on my show so many times, but it's like, how did you get the experience without taking enormous losses? And a lot of what he explains is that things have changed and business was a little bit easier back in the 70s and 80s. It wasn't so volatile back then. But with that said, he also aligned himself with mentors and people who had done what he'd been trying to do. And especially in a field where there's just not a lot of support. I mean, you've got all these boot camps and programs that people buy and stuff, but sometimes it's outdated and sometimes it's not really the mentorship you need. So again, he just aligned himself with the right people. And he did that by offering a part of the deal to participate, or, you don't just call up someone and say, hey, can I pick your brain? I have people do that to me all the time. Can I pick your brain? No,
brutal.
I really like my brain the way it is. Thank you.
Yeah, right.
And do I want someone to take me out to lunch so they can pick my brain? No, I can really afford my own lunch. So
yeah.
These aren't enticing things, right? But when someone, I'll give you an example. Someone came to me and said, can I help you? And I had a guy come and work as an assistant for 6 months, free, full time. That wasn't, can I pick your brain? That was, can I help you and be an intern for you? Of course, we ended up hiring him after 6 months of dedicated service. So I think, this is what this guy did, is he would say, hey, mentor, I found this deal. I'll give you half. Show me how to do it. And that's how we learned. And now he's doing that with me, and it's fantastic.
That's great. That's one of the things too, Kathy. It's the same thing. It's like when people say pick my brain, I cringe, It's like it's the same answer. And then exactly what you said. So like the same thing I offer to people in the markets that I am. I have, 12 people or so on my team. And I personally look at every deal that comes through each of the 3 markets that we're in. And the way to get, quote unquote, free mentorship from us who are actually closing deals and getting paid from deals in these markets is to bring the lead to the table. Come to the table with the lead on the deal. We'll help you negotiate, figure the numbers out. We do all of that for the people in our markets. But absolutely the best thing, the highest value you can bring to the table is not a check for $2,000. I don't want your $5,000. I don't want $25,000 check to mentor you. I want you to do the action, find the lead on the deal, and then bring that back and we can discuss something in real time as it's happening with the potential for the payout. Cool. So Kathy, please, if you could, do you have maybe 2 or 3 life-changing books, either real estate business or mindset success related?
Absolutely. I'll give 2 mindset because I think you've got to have a mindset first or everything will fall apart no matter how good it looks. If your subconscious repels success and money, then it will find a way no matter what. The one book that I think probably a lot of people, these are old, so people might have already read them, but The Millionaire Next Door, great book, Millionaire Next Door. And the other one is The Science of Getting Rich, 2 of my favorite books.
Yeah, I read them both. Science of Getting Rich is what, Wallace Wattles?
Yeah, that was transformational for me. I don't know why. It just was what I needed to hear. I think it was that, having been born and raised Christian, there was part of me that felt it was evil and bad to be wealthy. And that book sort of shifted that for me. Because of all the things you can do when you have money that can make a difference in the world.
Yeah, you're absolutely right. We could have a whole nother episode on that topic. And if you could share the crown jewel of wisdom with your 18-year-old self, what would that be?
Gosh, again, it'd take days for me to really go into that, but I would say just the truth is keep following your heart and trust that when if you follow your heart and you put everything into whatever it is that you're being guided to do, even if it makes no sense at all, it will make sense someday, especially if you just keep moving forward. And especially when you find yourself facing loss or disappointment or, things you didn't expect, to once again say, this is probably part of the plan, probably something I needed to learn to take me to that next level. And if you can take everything and learn it and move forward, you will see it all come together. So now where I sit, I can see that all those difficult times were what I needed to be an expert, what I am in now, that's helping others avoid those mistakes. And, it's just really, it's just guided me. Simple example is I wanted to do a TV show. I pitched and it just wasn't going anywhere. And I just came home and was like, fine. And as soon as I let that go, somebody called me about radio. I was like, well, I've prepared myself for TV. Radio's not that different.
If anybody wants to reach out, get some more information about you, your company, do you have some contact information you'd like to share with our listeners?
Sure. Our website is realwealthnetwork.com. That's real like real estate, wealth like your money, and network as in the network we have nationwide to help you find great deals. realwealthnetwork.com. Membership is free. You just fill out a couple of questions that helps us understand what you want, and we only send you information on that and lots of education. So realwealthnetwork.com. You can also get my book, Retire Rich with Rentals, on Amazon.
Kathy, it's been an absolute pleasure having you on the show. I'm sure the 10 years on radio have helped you be such a wonderful guest, and you shared a lot of great information here.
Thank you so much. I really appreciate it. It was fun.
And thank you for listening to this episode of the REI Diamond Show. Are you receiving new episode notifications? If you'd like to, you can sign up at www.reidiamonds.com. And if you are working a deal in any of the markets that we operate and you would like our help with that deal, those markets are the Tampa Bay area in Florida, Philadelphia tri-state region, and the Chicagoland area. You can contact me by going to reidiamonds.com, and in the bottom right-hand corner, there's a link, and you'll be able to enter the information there. Thanks again for listening. Dan Breslin here. I'll catch you next time. And remember, here at the REI Diamond Show, we're dedicated to helping you increase and protect your net worth.
Thanks for listening to the REI Diamond Interview. To receive the REI Diamonds newsletter and interview monthly, sign up now at www.reidiamonds.com.